What's up, guys? Welcome to Heresy Financial. We have just about 1 month left in the year. I hope you guys are all enjoying your Thanksgiving weekend. Meanwhile, geopolitical tensions are increasing and economic conditions are worsening. Today, we're going to be diving into a couple of things that are going to paint a little bit of a picture about what is happening globally right now. We're going to look at central banks and how the gold buying spree has been continuing, what that means for the dollar in conjunction with what is currently happening in Hong Kong and China, with Congress passing the Hong Kong support bill and then President Trump signing it Wednesday night after the market closed, going into the Thanksgiving market holiday here. We're going to look at China's response, what it means, what they're likely to do, and what the potential outcomes could be when this all starts to unfold here. Let's dive in. All right, guys, so first I want to apologize for the lighting in here. I'm in Phoenix, Arizona, and winter is setting in here, which means we're finally getting some long overdue rain. And so the cloud cover is coming and going, so you might see the video get lighter or darker as it goes on. I apologize for that in advance. Number two, if you enjoy the content in this video, I'd love it if you'd like and subscribe here at the end. It would mean a lot to me. Okay, so quick recap on the gold market here. 2018 marked the highest gold buying year on record by central banks since we left the gold exchange standard in 1971. Central banks have been on a gold buying spree, and even until this year, and it looks like we might surpass that this year as well, as central banks, especially Russia and China, have kept on their gold buying spree. Other central banks around the world have joined into the gold buying. Most recently, Serbia joined the gold buying spree. Central banks around the world, especially in Europe, have come out and said, hey, storing up on gold is going to give us some stability amid geopolitical tensions and economic uncertainty. So while central banks are devaluing their currencies at record paces and cutting interest rates and printing money, you also see central banks loading up on gold themselves because they realize their own money and other central banks' money does not have any real value. And the only way to solidify their security and actually have some financial strength is to own something with intrinsic value like gold. So a really interesting story happened recently where Poland repatriated all of their gold. Now, historically, they had their gold stored at the Bank of England. Now, the Bank of England was storing their gold for them because Poland was concerned about war, things like invasion, Russia coming in and taking their gold. And so Poland had stored its gold at the Bank of England. Well, the fact that they repatriated their gold means that they're more concerned about the collapse of currencies, economic conditions, or about even the Bank of England not being willing to give them their gold when and if they need it, if the time comes. And so the most concern that they have right now are those other things. They're not as concerned about somebody trying to steal their gold. So they said, hey, let's repatriate it. But what is really, really fascinating about this story is that right before they announced that they were going to repatriate 100 tons of gold, they had just purchased 100 tons of gold from the Bank of England. And they already had 123 tons of gold at the Bank of England. And so instead of repatriating all their gold, what they did was they purchased new gold from them and then repatriated that gold. Okay, so this leads credence to the statistics and the numbers that have been circulating around the internet lately that there's a lot less physical gold in existence than there are paper obligations to it. And that as things ramp up and geopolitical tensions increase and people are trying to reclaim their gold, and as the real value of fiat currency goes down and futures markets might slip into backwardation, you might see more of a demand for physical commodities than the demand for the cash and then trading futures on it instead. And so you are seeing things like this happen where there's not actual enough gold, physical gold in the bullion banks as there are paper obligations that are demanding it. And so whereas they could have just tried to repatriate their 123 tons of gold, maybe the Bank of England didn't actually have that much. And so they said, hey, if you want to repatriate any, you have to just buy fresh gold from us. And so it's interesting that they repatriated 100 tons, which they had just purchased, and left 123 tons there with the Bank of England. So we're likely going to see more and more things like this happen, especially from the Bank of England, because England doesn't have any gold. They sold all of their gold. It was either 2003 or 2013. I can't remember the year, but they sold 100% of their gold reserves. So they don't have any of their own. And so countries who store their gold with England are thinking, hey, if things get really dicey and everybody wants gold, Bank of England might just say, nope, all this gold is ours now. They might just confiscate it. And England has done that before. America has done that before, most notably in 1971 when we closed the gold window and Nixon closed it. And so it's not one of these things that is out of left field, something that should be completely unexpected from a global political perspective. It's got lots of precedents for countries just confiscating gold from other countries that they're holding of their allies there. Okay, so why is this important? What does this mean for the average investor? Well, the price or the value of gold follows central banks. So I'm going to throw a chart up here on the screen here, and you can see the raw price of gold in dollar terms. And you can see this is not adjusted for inflation at all. So this is just the straight dollar price of gold. So you can see the movement very clearly there. Because when you adjust the price of gold for inflation, the movements become a lot more muted, which makes sense because the value of gold is very stable. And so the adjustments in the price of gold are going to reflect the value, which means that it's going to look very similar to inflation. So if you want to have a good idea of the value of the dollar bleeding out, you can compare it against gold and basically look at a non-inflation adjusted chart of gold like this. So if we look, we can see the price of gold was on a decline until about 2000. And in 99, all the central banks got together and they said, look, we're dumping too much gold onto the market all at the same time. So we need to set a coordinated max limit of gold that can be sold at any time by all the central banks so that we don't put too much of a downward pressure on the price of gold here. And right at that point, that's when the price of gold turned around because obviously, it's supply and demand. The price is going to be governed by supply and demand. And so there was less gold being sold by the players who have the most gold at a time. And so the price of gold turned around. Well, recently within the past year, that agreement came up again as far as it needing to be renewed. And quite frankly, none of them cared. None of the central banks cared about that agreement being renewed because for years, central banks have been net buyers. There's that lighting change again for you. Sorry about that. But ever since the last couple of years, central banks have been net buyers of gold, not net sellers. And so it was a useless agreement because nobody's selling gold anymore from the central banks. And so central banks are all net buyers now of gold. And so you've seen that as first, in 99 when they capped the amount that could be sold, and then central banks on net turned into net buyers of gold rather than sellers. That's what's been driving the price of gold. And that trend is continuing. So central banks are the ones that are driving this price of gold going higher and higher, even especially as they are driving the values of their own currencies down by printing more and more, cutting rates, quantitative easing happening all around the world. And so this is what's driving it. The central banks, I've said this before, are the biggest money. And if you want to follow the trend, follow the big money. The big money is what makes things move. All right, so that's gold for you. Let's shift a little bit and look at what's been happening with Hong Kong and China. So Congress recently passed a bill supporting Hong Kong, and Trump Wednesday night, right before going into the Thanksgiving holiday, signed the bill. And so this puts America supporting Hong Kong and effectively shuts China out from funding from what was once and probably no longer will be, at least for a very long time, the financial center of Asia. Hong Kong, the #1 most economically free country in the world by the Heritage Index, the Heritage Economic Freedom Index. I'll throw that up on the screen here as well. But they've been the #1 most economically free country in the world. So it makes sense that they've been extremely prosperous. And so Hong Kong was a major financial hub, and it allowed a lot of money to come into China for its Belt and Road project, for its infrastructure building projects, for everything that it's trying to do to grow and expand its economy and its influence, especially in the Eastern Hemisphere. And so Hong Kong is central to China's plans. And so America effectively is coming in and saying, nope, we are stopping funds from flowing into China through Hong Kong. Now, a lot of people have said that China is on thin ice here, that America holds the upper hand. We're the consumers. They rely on us as a consumer base. That couldn't be further from the truth. China has been the only one that has allowed America to have the consumer base that it does. The U.S. government and the national budget is financed through debt. And China has been the one holding that U.S. debt. And historically has been the one buying all that new debt. It's been the one loaning the money. It's been basically financing its own consumer base. China is huge. They produce things for themselves. If that whole entire relationship were to end, China would have the upper hand, not America, because America doesn't produce anything. We rely on other countries to produce things for us. And so we don't have the means to produce for ourselves or to finance our own spending. And so China, on the other hand, does. They produce things a lot more than America does. And yes, they rely on consumers, but they also have 1 billion people in China. So if that whole entire relationship were to end, they would have the upper hand for that reason. But for the second reason, that they could go to that nuclear option. And so while they don't have, right now they're kind of cut off from that Hong Kong funding, being the central source of where that funding is coming from other countries. They hold a massive amount of foreign reserves. And so if they need to, they can tap into those foreign reserves. They can start selling down, especially U.S. treasuries and dollar assets. Now, what is that going to do? It's going to drive the price of the dollar and treasuries down. And so what does that do? I've covered this in other videos before, but bonds, when the value of the bonds go down, the price of the bonds, that drives interest rates up. And so it's called the nuclear option because they hold so much US debt, they could just flood the market with it and just dump it all and sell it. Yes, that would turn the world into kind of a global tailspin. It would, cause a lot of chaos and financial panic unless the Federal Reserve stepped in to be the buyer. Light changing again, sorry about this. So unless the Federal Reserve stepped in to be the buyer of those treasuries, and they would have to because the federal government cannot afford a spike in interest rates. The actual debt service, just the interest portion of all of their debt, would very, very quickly just take over the entire budget. It would be too much for them to be able to afford. So the Federal Reserve would have to step in and buy all of the treasuries that were flooding the market. The only way they're going to do this is to print money. And if they print money to buy up treasuries and to absorb all that selling, the only result of that is going to be price inflation, and so prices are going to skyrocket. And so China actually holds the upper hand here in this, and so America is the one that needs to be careful with how we proceed here because if we cut off their funding, they have a massive source of funding that they could access by dumping all U.S. treasuries and dollars onto the market, and that would be better for them, worse for us. Meanwhile, we're going to shift to what the Federal Reserve has been doing, and we've seen the repo market operations continue relentlessly, and they've been growing. And so not only are we concerned about, if we hit recession, tax revenues go down, and expenses go up because there's more welfare spending, there's more government projects, and so income revenue goes down, expenses go up, and we're not even in the recession nominally yet, and we're already seeing the Fed have to, basically it's been doing quantitative easing this whole time through cutting interest rates, through the repo operations, and through now they're buying US Treasuries again. And so they're already in this debt monetization process, and we haven't even hit recession yet. And so with that risk of, the nuclear option in China or other central banks even starting to dump U.S. treasuries, not a good sign that without even any of that happening, the Federal Reserve is already basically in emergency panic mode, performing what looks like to be a big bank bailout, stealth mode bank bailout through the repo market. So it looks like there is some large player with really bad collateral that they're basically just getting bailed out right now overnight through the repo market. So not a good look right now. And this is one of the reasons why, number one, the founding fathers never wanted there to be a central bank in the first place, because they knew something like this would happen. And that was why laws like debt monetization laws were put into place to prevent the Federal Reserve from buying U.S. debt directly from the U.S. Treasury, because they knew something like this would happen. They knew that it would be too easy for the government to just blow up their debt. We're already seeing the debt that the U.S. Treasury is issuing basically go directly to the balance sheet of the Federal Reserve. An example here I'll throw up on the screen. You can see the QSIP numbers. This Treasury that was issued was on the Federal Reserve's balance sheet less than a day after it was issued. So if it even did go to another bank's balance sheet before it went to the Federal Reserve, it was there for less than a day. That doesn't count. That's basically a technicality, a loophole to get around that. So the Federal Reserve is already directly monetizing U.S. debt. They're already performing this debt monetization, this quantitative easing, especially through the repo markets and cutting rates and keeping this debt low. And we're starting to see the market react. That's why the repo market operations have been having to happen, because you've seen the interest rate spike. So when you manipulate a market and try and control it, beyond what the actual market would want to do, you can't actually control complex systems like that. So it snaps back on you in ways that you don't expect. And so mortgage rates have been rising. The repo market they've been operating in has been, getting more and more extreme. And so that's why those repo amounts have been growing overnight. And so not a good sign here. So all of this kind of loops into this picture that we have right now coming into the year end of the Federal Reserve and the American government trying to control things that they can't control. And the more you try and control those things, the more they push back. And at some point, things are going to snap. At some point, the economy and the free market is going to snap back. And because they've been containing things and holding things down, manipulating for so long, when it snaps, it might really start to break things. And so not a good look coming up on the end of the year, but usually things take longer to unfold than you would expect. And John Maynard Keynes, the founder or the father of modern macroeconomics, he said the markets can remain irrational longer than you can remain solvent. And that is certainly true. So you see these things take longer to unfold than you think they should. And so it's anybody's guess how long the Federal Reserve and the government will be able to manipulate things, but at some point things are going to start breaking here. So in conclusion here, we see gold buying by central banks increasing. That spree is increasing even as they are devaluing the money that everybody else has. And so basically do what they do, don't do what they say. They say, hey, take our money is good, our currency is good, but they don't believe it because they're not holding it themselves. They're buying up gold at a record pace. And before I move on in this conclusion, I want to make a side note here because I forgot I was going to talk about this. Gold-backed cryptocurrency by China. That's another option they have as well, and that would really crush the dollar. If there is a gold-backed finite currency that was, China has been building relations with countries all over the Eastern Hemisphere. They would have a lot of buy-in by this globally if they were to launch a gold-backed cryptocurrency. Finite supply, settlement in real gold, so there was no manipulation, there was no inflation that could take place. Those are, basically a hard currency. And so there are rumors that they have a lot more gold than they've been letting on, which, in the past, those rumors have always come true because they buy gold without actually telling people that they're buying gold. And so, then the next time they update their gold balance sheet, it shows they have a lot more than people originally thought. And so them in coordination with Russia, who have already dumped most of their dollar reserves and replaced them with gold, they could launch a very widely accepted gold-backed cryptocurrency, and that would be the final nail in the coffin on the dollar being the global reserve currency. And that would, be a long-term benefit to the world, but short-term that would be a big, damaging nail in the coffin to America and the dollar. And so that is another option that we might see unfold and come into play soon here. But with everything happening, central banks buying gold, China, the nuclear option they have with unloading all the treasuries that they hold, with those tensions rising between America and China right now centered on Hong Kong, and what the Federal Reserve is already having to do with being in emergency mode, debt monetization, and bailing out banks, it looks like, through stealth repo operations. It's anybody's guess what 2020 is going to look like. And so at the very least, it looks like it should be a wild ride. It shouldn't be a boring year. And stay tuned for more so that you can stay up to date on what is happening and things that CNBC or MSNBC or the major news outlets are not really talking about. And so stay tuned. I'll keep you up to date on what matters for you and your money. And if you would like to support me, I do have a Patreon. You can click on it down in the link below and support me on Patreon so I can continue to make videos like this for you. Thank you so much for watching. You guys have a great day.